Hi, friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
And all right, so today what we wanted to get into, if you remember last week, we talked a little bit about, I think it was a tweet that Trump had put out, or I should say a truth that Trump had put out on Truth Social about how Jerome Powell's termination could not come soon enough. So we did talk a little bit last week about just like why the independence of the Fed is so important, why firing the firing the chairman of the Fed is not necessarily in the best interest of anybody. But what happened this week was Trump got even more aggressive. There was an article, I think, in the Wall Street Journal that came out that explicitly said that Trump has been talking to advisors about firing Powell. And he also put out a number of, again, quote unquote, truths.
Is that the unit of a post?
I think so. Well, it's a tweet. Okay. Is it even a tweet anymore, or is it an X? I don't know. So
yeah,
again, I guess I'll call it a tweet.
Of measurement. This is
I don't
keep me up at night.
The article I read, it calls it a truth. So I was like, I don't know. We're gonna stick with tweet. It's a freaking tweet. But so he put out a tweet that said something along the order of like, Jerome Powell is a loser and he's always too late and inflation's not going up and all this stuff. And the markets had an absolute conniption fit. So equities were down. It was kind of like back to what happened post Liberation Day. So the next day he did walk it back. And then the president has come out and said like, no, I'm not firing the chairman of the Fed. So Jen is going to get into a number of things on the monetary policy side, on the Fed drama, and she's going to explain to us like just some cool takeaways.
Have fun.
Yeah, have fun. Second thing that happened is that the US dollar drops to a 3-year low. And China also, by the way, drops to an 18-year low. And this is what happens, I feel like, is like we get conspiracy sent to us via the form of like the internet. And so then Jen wants to like go ahead and debunk shit that's absolutely dumb. But what Jen is going to get into is a very high 10,000 foot level overview of some FX things related to why the US dollar dropping to a 3-year low is concerning, especially in light of the fact that, sure, that the dollar was lower in 2008. Like, why is that not comparable? Why is this so much more concerning? So again, second thing we're going to talk about today is basically like the dollar. And then finally, last week, we've done a number of mini segments at the end where we talk about endowments and the Swenson model and all this kind of cool stuff. Well, Yale, PS, is actually in the market. Apparently, they've hired Evercore to try to help them sell their $6 billion private equity portfolio. And so we want to recap what the heck is a secondary? Why is this so interesting? And so again, at the very end, we're going to get into sort of more of like the asset management, corporate financing, whatever space. So that is the agenda. So with that, Jen, I'm going to have you kick it off.
I can't even remember what I was supposed to talk about first. I think it was the Fed.
The Fed. We're talking about Fed and the fact that the markets,
We've been on this roller coaster ever, basically for the past, it feels like month. I'm aging in dog years. But like you said, Kristen, on Monday, I think, when Europe was out, by the way, because a lot of people were still off for the Easter holiday in the US, markets were thin. There wasn't a ton of liquidity. Markets are always a mess when like Europe is out, like all of Europe.
Because it was Easter Sunday and then it's the Easter Monday.
Yeah, exactly, which our markets don't celebrate, but other countries do.
I will say, and in Boston, we had a holiday. It was Marathon Monday. So everyone has to work.
It is a good holiday. Like,
that's
like such a cool Boston holiday.
But here's the thing. It's like you have to work from home because what happens is like there's a blockade. Like you literally can't go from one side of it depends where you are. So anyway, so we had a holiday because of that. But I'll let you continue.
My kids didn't have school either because my kids never have school. But but yeah, so we had this commentary that the Fed is too late. The Fed should have already cut rates. Jerome Powell's a loser. He's got to go. The markets went, like you said, absolutely ballistic after leaving for the weekend, feeling kind of good. And then by the end of the day, Trump effectively started walking back his comments and saying like, oh, I'm just kidding. Like, all right, maybe I'm fine with it. And markets totally rebounded in the other direction. And what I think is so interesting is at the end of the day, we're in this kind of cool place where we have like proof of concept almost, where Kristen and I being two sides of this coin, right? We sit here and you have someone who has the corporate advisory. What are the fundamentals and how do we value a company and like this very investment banking vertical side of things. And me who only knew markets and didn't know anything about your world, right? And I think that when you're so in the weeds with valuing companies, like, again, things like interest rates or things like inflation numbers or whatever they are, they're just like one little input in a model and they don't really matter, right? And I think what we've had for people who maybe thought like, oh, the sexy thing of the past 15 years has been just investing in individual companies because we've been on this tear. I think it's actually really interesting to see that at the end of the day, it is the markets that are forcing Trump's hand. The efficiency of the markets and this beautiful thing where this is what matters. At the end of the day, it's not some advisor who has like, infinite wisdom or insight. It's not a bunch of politicians sitting around in a room making a decision. It is truly the markets that ultimately has stayed Trump's hand and is now impacting the kind of policy that he is talking about. It's like this beautiful, like, hey, these markets really do work. Everyone who thinks markets are just gambling and like, oh my gosh, like you can't beat the market. So like, why bother? Blah, 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 blah. This is, I think, like the most compelling proof of concept we have that like these free, efficient markets are in fact like smarter than all the rest of us, right? I think it's like this magical thing.
Yeah, no, and actually totally unrelated. It's interesting because the banks, their sales and trading divisions have gone bananas recently because of all the volatility. So like they're doing very well because of sales and trading right now. And there was a very interesting article literally today talking about how Jane Street, which has become a huge market maker, they're basically they started as like a prop shop. Like we actually, by the way, do have a whole episode on Jane Street as it related to Sam Bankman-Fried, because that's where he started his career. And it's this like super secretive firm that like people hadn't heard of. And then all of a sudden, like now it might be more mainstream now. I'm not sure, but yeah, I feel like nowadays people know because again, it's a behemoth.
I thought it was a hedge fund. Like,
well, it's a whole bunch of things. It's a whole bunch of things. But the point is that they literally came out, their revenue from trading eclipsed Bank of America and Citi. So kind of unrelated, but it's an interesting
and we got a question on our social media over the weekend asking, is now a good time to start a career in fixed income? And I was like, oh my God, like to be on a trading floor right now, like if you are running a portfolio and you're managing a book, I do not envy you. I cannot even imagine how stressed out you are right now. But times of massive volatility are amazing times for sales and trading desks at investment banks and for market makers, because more volatility, people who at the margin might not have a view might need to do trades. And as volatility increases, bid offer widens out. Yeah. So it's a super stressful time, but like this is when careers are made. In 20 years, we're going to be telling the stories of like the legends who were forged in the fire of spring of 2025, right? Yeah. Just how we're like, oh, we got our start during the global financial crisis. And people are like, oh, you've been in it. Like, you were in the trenches, right? There are going to be absolute trading legends who come out of this time in the market. I 100% guarantee.
And it is interesting because it's like, as you think about these banks, I mean, the M&A activity, we talked about this, M&A, IPO activity, like they're not going to be making much of anything there. There was also, I guess, banks are starting to get worried, like the leverage finance team, like again, financing deals by private equity firms, like they're worried about what's called hung deals, where again, the bank is on the hook for these deals and they can't do anything. This was like a huge issue actually back in 2008 when I was working in CLOs. Like we had like this whole warehouse.
What a hung deal is for people who haven't heard the term before?
Yeah. So the bank agrees to help whatever the firm is raise money. So in the case of like Carlyle coming to try to buy a company, they need financing, right? They need the loans or whatever. Now, typically, if you go to Bank of America, they don't want to loan that entire thing to Carlyle to do the deal. They often like don't have necessarily the balance sheet, whatever. So what they do is it's called syndicate, right?
They form a group.
Yeah, they form a group.
Banks, and they all get together and they say, okay, syndicate. Together we are going to underwrite this massive amount of debt in the hopes that we can then sell it out to all of our clients who are going to purchase pieces of these bonds or pieces of these loans, right?
Yes. And so what's happening is that is not necessarily, like banks are not necessarily able to do that. Now, in 2008, when I was working in CLOs, what would happen is like there would be, again, all of these deals. And so the banks would have then on their balance sheet a lot of these loans. And then you would want to like package it up, put it into a CLO. And then whoever the investor is, there was a whole bunch of people who invested in these securitized products who would buy the packages. So again, it's allowing the bank to then free up the balance sheet to continue to lend. And so that was a huge thing in 2008. But the Bloomberg article I happened to see this morning, they were talking about how like banks are still willing to do it for the right price. But again, like the whole point is there's a whole bunch of just fees that are drying up related to more corporate advisory. Whereas on the sales and trading side, like this is why being a bank and having like these different verticals is helpful. It's like diversification, right? So
Exactly.
anyway.
I always think of a hung deal as like you and a bunch of your friends are all in a group chat and you're like, we're going to go stay at this really expensive resort and blah, blah, blah. I'm just going to put it on my credit card. Okay. And then you guys all pay me back when we get there. And you show up to the vacation and no one else shows up. Right. And you're
Such
like,
a great
no,
analogy.
I'm on the hook for like $10,000 on my credit card. I don't want this. Right. I don't need 10 rooms at this hotel. Like,
yes, I love that. I love that analogy.
But yeah.
Well, so the next thing we wanted to talk about was this whole idea of Operation Twist.
Oh,
so
yeah. Okay.
last week, so just to recap, last week, Jen did this, again, sort of amazing explanation talking about quantitative easing versus quantitative tightening and this whole thing about the Fed sets the short end of the curve, the market sets the long end, but there are tools that the Fed has in their toolkit, right? They can engage in quantitative easing. Well, there's this other little thing called Operation Twist. And so I had never heard of this. And so Jen is very nicely going to explain to all of us what Operation Twist is. Because it's like this like arcane weird thing that the Fed theoretically can do. I don't know.
It's what investment bankers and their cubicles don't care about, but this is what the rest of the world cares about. No, but so we always talk about the Fed expanding or tightening their balance sheet in kind of blanket absolute terms. We rarely ever talk about the composition of its balance sheet. And so if you think about a graph, for those of you who are watching on YouTube, we have actually now learned how to add in a graphic to the middle of our podcast. So here is just a simple drawing of a hypothetical yield curve. And you have the x-axis is years all the way from 0 to 30. And you have a y-axis, which is interest rates, right? And the US government borrows at various intervals all along that x-axis where their debt matures in either 1 year, 2 years, 3 years, 5 years, 7 years, 10 years, 20 years, 30 years, all the way out. And each of those maturities corresponds to some interest rate where they can borrow. And if you think about plotting those points along those two axes, we build something called the yield curve. Think about each of those points representing concentrations of debt. That debt rolls down the curve as it matures. Okay, so when the Fed goes out and they buy treasuries in what's called open market operations, when they are doing quantitative easing and they are expanding their balance sheet, they get to choose where they're going to buy. They don't necessarily buy all treasuries that are maturing in 30 years or all treasuries that are maturing in 2 years. There's some composition of that portfolio effectively, right, of what they're buying. And so when the Fed initially started its program of quantitative easing in 2009, 2008, 2009, I don't remember exactly, when we had like the first open market operation, I was sitting on the trading floor at Barclays wondering if I'd have a job. But they would announce daily or weekly open market operations. And they would say, okay, today we're buying stuff in the 5-year bucket. Today we're buying stuff in the 10-year bucket, et cetera, et cetera. And they would basically solicit offers on those securities and, all that fun stuff. So what ended up happening is that the Fed built up this portfolio of securities that, as they started to age, were more highly concentrated towards the front end of the curve, towards shorter dated maturities than longer dated maturities. And we got to a point where the Fed didn't want to necessarily expand its balance sheet further, but felt like they needed to do more to impact the long end of the curve. So again, back to our conversation from last week where we were very just simply laying out the Fed's toolkit. We said, okay, they can set that overnight rate in the very front end of the curve. And then they can do open market operations to lower long-term rates. But the Fed actually did something where they shifted the balance of their allocations from the front end of the curve to the long end of the curve. And by the way, I have no idea if I'm going to be flipped if my hands are in the wrong place. So I apologize in advance if this is all
They probably are. I'm
trying to think backwards. I'm doing it backwards because I think
doing it backwards is right. Doing it backwards is right.
I'm trying, yeah. So basically what they did, I think they did it to the tune of something like 667 billion worth of treasuries. But over the course of something like, I think they announced it in 2010, and then it was 2011 to 2013. They basically sold out of the securities that they had in the front end of the curve to buy longer dated securities at the long end of the curve. And where there's more demand for a security, its price goes up. And remember, when there's more demand for interest rate products, that rate comes down. You're willing to accept a much lower rate of return when there's more demand. So that was the theoretical goal, was to effectively, if you think about that graph that I drew, flatten the long end of the curve relative to the front end of the curve. And we did see the yield curve flatten over the ensuing 10 years to the point where it actually became inverted, where short-term rates were higher than long end rates. Somebody has probably written an economics PhD thesis about this. So like, I have no idea. But the question is to how much of that can we attribute to the Fed's action of Operation Twist? And how much was what happens in markets as well, where as views on future monetary policy shift, that also impacts the shape of the curve. There's other supply demand factors beyond just the Fed that impact that. So if you expect that interest rates will be lower in the future, that's going to also flatten the curve. So there are a lot of different things that could have been responsible for the gradual flattening of the curve over time. We also tightened monetary policy. The Fed actually started hiking before then COVID, and then we had to go to zero interest rates again, and then we hiked again. So when the Fed raises short-term rates, right, all else being equal, that's going to contribute to the curve flattening as well. So one of the tools in the Fed's toolkit that we didn't discuss last week that somebody brought up in a comment on one of our social media videos that we felt is great to educate you about is, again, the potential for that Operation Twist. What this is distinct from, though, is something that was discussed on a podcast that we listened to called
The Odd Lots. Yeah.
Yes. And what they talked about was a debt swap. And they talked about specifically, they made a wonderful reference to our friend, Sujit Indap, who was one of the co-authors of Caesar's Palace Coup. Small plug, if you guys go back in our ancient history, we did a 3-part deep dive on one of the biggest LBOs with some of the most disastrous consequences of all time. G and his co-author Max Frooms wrote a book called Caesar's Palace Coup about this. And one of the central themes is this creditor on creditor violence, is basically the forced subordination of different creditors who own the debt of that company to one another. And it was actually this really interesting scenario where effectively the debt holders got subordinated to the equity holders, which is like, the whole laws of the universe being turned upside down. Neither here nor there. But basically what this Odd Lots episode was toying with was this theory that, hey, listen, we always say that these bond covenants and documents are these ironclad things. As we learned in that book, and as we learned from the history there, actually like the placement of a comma, like a vague sentence, when interpreted in the courts of law, can actually turn your whole beliefs about this system upside down. And so what Odd Lots and their guest, I forget his name, was the thesis that, hey, how ironclad are the documents governing U.S. treasuries? And their answer, and this is not something I've looked into. I've actually never read like one of the indenture, like one of the—
Who would? Who would? You're like, I want to put my money into safe stuff. Like just buy, get me in a money market fund. Like I'm going to buy some treasuries. Like what?
Well, again, this is where like my English major would likely behoove me, but this is also why I did not become a lawyer, because the idea of reading through legal documents is truly my worst nightmare. But what their analysis was is that shockingly, like the language isn't as ironclad as you might think. Therefore, there is a universe in which unilateral action from the government could say, hey, listen, we told you this bond matures in 2 years. It matures in 100.
Which is
insane. Turn out instantaneously in one fell swoop with a pen, basically, the entirety of the US's debt. Because we always talk about how much debt we have, all the debt that we need to refinance because it's rolling off and we need to continue to fund our operations. Well, what if we just took all our existing debt and said, hey, it doesn't mature tomorrow. It doesn't mature in 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30 years. It all matures 100 years from now. Problem solved, right? Mm-hmm. The idea that you could do that, and I just hope that if any policymakers are listening and they're like, this sounds like a great idea. This is you need 2 keys for that operation, because you do that once and you never get to do anything again. Because if you try to auction off debt the next day or the next week or the next month after you pull a stunt like that, who's buying your bonds? If you're like, this is just a vague suggestion of when I think this thing will mature, like it's not really like
honestly,
a date. Like
I heard that episode and I have a public account with treasuries, but I was like, shit, I need to go sell this. And by the way, fun fact, also, apparently, did you know that Warren Buffett holds 5% of US T-bills? He might need to also swap out some stuff too.
Sorry, that his holdings, that 5% of his allocations are in T-bills, or that he holds 5%
I think he owns 5%
outstanding?
That is my understanding. Let me double check that.
4.89%,
Yes.
$300.9 billion in short-term government debt.
Yeah. So this was a Bloomberg article from this morning that says Warren Buffett now owns roughly about 5% of all U.S. Treasury bills. So maybe if he's holding it, he's not nervous. And like, I trust him.
To be fair, again, I don't want to say no one should be nervous because we live in a world where crazier things have happened, right? But again, I know we are a very small podcast. If there are any government decision makers who are listening to this podcast and you think this is a good idea, I urge you to strongly reconsider. This is a terrifying idea. This is break glass in case of emergency. And like, you get to break that glass once and then you need to accept that like we're living in the Stone Ages after that. You can't
well, do that. I mean, then that actually kind of like does translate or go well into the next topic, which is like basically the dollar dropping to a 3-year low and loss of confidence, because it did seem to be precipitated. And again, who knows causation, like, but it was during the commentary by Trump about possibly firing the chairman of the Fed. So,
well, yeah, again, what we've been experiencing over the past 2 weeks has been, or 3 weeks. God, it's been 3 weeks at this point, Kristen. Oh my God. What we've been
like I've aged 100 years.
And we've talked about kind of ad nauseum here is the shaking of confidence in the US dollar. And so all else being equal, when you have a country that has a freely floating currency, and we'll get to this in a second, but a currency that is just allowed to trade in the open market, all else being equal, when that country is in a period of easy economic policy, its currency should be lower. And when that country is in a period of tighter monetary policy, meaning higher interest rates, that currency should be higher, all else being equal. And so there were two things we saw on social media that prompt kind of this conversation about the US dollar and the Chinese currency. And so one is that, yes, the dollar is at 3-year lows. Yes, that is concerning. Is that the all-time low for the US dollar? No. But what Kristen was reacting to was a comment on our social media being like, who cares that the dollar's at the 3-year low? It's nowhere near where it was in the mid 2000s in terms of it's still stronger than it was then. So who cares? This is just a blip on the radar. Well, remember, in the mid 2000s, we were in the midst of the global financial crisis. So we were cutting rates to zero. We were implementing all these quantitative easing strategies. The Fed was expanding its balance sheet. The Fed is right now contracting its balance sheet and it is on hold. Now, could this be presaging easier monetary policy? Absolutely, right? But this dollar weakening is telling us that we are in a state of certainly uncertainty, if not potential impending slowing of growth and potential crisis. The other thing to think about is it's not necessarily an accident that the dollar is weaker. The logical outcomes of these policies are a weaker dollar. A weaker currency, all else being equal, benefits a country that depends on exports.
And I want to actually just double click on what we mean when we say weaker dollar, because for people who are not like in the FX land, basically it's like you think about if you go travel internationally, you go to Spain, you go to Switzerland, if you have one US dollar, like how many euros is that translating into? There's all these different FX pairs with all these different countries all over the world. You want your dollar to go farther. So if you have one US dollar, are you getting 1.5 Canadian dollars? Are you getting 2 Canadian dollars? You, as a consumer, want it to be higher because then you
Correct.
can spend more. So the stronger dollar benefits you as a consumer.
Correct.
But again, it does not benefit us as an exporter. So I just wanted to make that little point because like I literally, when I hear FX stuff, I just get confused and I tend to tune it out. So that's why I just wanted to make that little point.
Yeah, so you're 100% right. You go to one of these countries, you booked a vacation, you show up and you want to pay for dinner. And pulling it to an extreme, if dollar euro were trading at 2, all of a sudden it's now going to be twice as expensive for you to buy something that's priced at the exact same numerical amount in Europe as it is in the US. It's going to be twice as expensive for you as the US consumer to come in and buy that product because
Right.
you have to convert your currency into the local currency. And if you have a weaker US dollar, that benefits us were we to be a country that was reliant on exports because it encourages people to come in and buy our goods because their currency is stronger than ours, et cetera, et cetera. So who has this been really extreme for? It's been really extreme for China. And so again, I am not an FX expert by any stretch of the imagination. So This is kind of like cliff notes, if you will, of FX and currency. And I'm, again, not positioning myself as an expert here, but what I saw that concerned me was a social media video. It was someone who has almost 150,000 followers who was sharing his take on the US-China tariff war. And his argument was that basically these recent developments in the markets proved that Trump's strategy for negotiating tariffs with China was actually succeeding in weakening China economically. And what he pointed to was a weak Chinese currency. Now, again, my view on these tariffs negotiations, specifically with China, is they are bad for both sides, right? Like China is dependent on the US, but the US is to some extent dependent on China. So putting us at odds with each other hurts us both. And the question is whom does it hurt more? And what this gentleman was pointing to is he was like, hey, the Chinese yuan, he called it, and I want to address that in a second, has fallen to its lowest level in 18 years. And that's going to exacerbate the real estate crisis they've been in for 5 years now and crush their economy. A couple things. Okay. China's currency is actually called the renminbi, which means basically people's currency. And you'll see it abbreviated RMB. But the units of that currency are not, it's spelled Y-U-A-N. It's not pronounced yuan. And my Chinese accent is terrible. It's like that awful girl at a party who goes to Spain for 1 week and comes back like with a lisp and, you know, the Ilaria Baldwins of the world. So I'm not trying to be that, but I do think it's important to at least know that it's not pronounced yuan. It's more like yuan. It's like an umlaut en if you think about it, like how it's actually pronounced. It's just a pet peeve of mine, but I think it's disrespectful to like not pronounce someone's currency. And again, that's the units of the currency. So it's like we talk about the currency in Great Britain being sterling, right? But you don't go to a store and you're like, that'll be 5 sterling, right? The units are pounds. So it's kind of analogous there. And then there's different denominations and, you know, like we have dollars and cents, right? Like, but anyways. Second thing is China's currency isn't like a lot of the other currencies that we talk about here. It's not like the euro. It's not like the sterling. It's not like the Aussie dollar. It's not a free floating currency. And that has not been its history the same way that all those currencies are. So starting around in the mid 90s, actually, and again, I'm not going back further than that. My history knowledge is simply not sufficient, but basically starting
back when we were 10.
Yeah, the mid 90s is back as far as like I can vaguely reference these things. The yuan was pegged to the US dollar at a kind of artificially low rate. And what's a peg? Well, if you basically fix the exchange rate of one item to another and don't allow it to fluctuate with market forces. And so how do you achieve currency pegs, right? Well, you intervene in these currencies. You go out and buy dollars to keep your currency artificially low. And so that peg kept China's currency artificially low and allowed it to grow massively into the exporter that it is today. Then in 2005, there was one day where they announced like an incremental revaluation. And they said, okay, we're no longer just pegged to the dollar. We're going to be pegged to this basket of currencies. And we're going to float, but we're going to stay within this relatively tight range relative to something. And we're not going to tell you what the weightings of the currency in those baskets are. It's going to be something. But mysteriously, when all other currencies in the basket are down and the dollar's up, the yuan is up, right? Like, so it seemed like people have called it like a dirty float or like a crawling peg. Like basically like, okay, there's something here, but like, we don't know what, right? And then in 2008, when we went through the global financial crisis, they kind of de facto basically just repegged because they were like, you guys are in such trouble. You're not going to buy any of our stuff. We don't want to get dragged down with you. Like, we'll lower our currency. This went on and on. And then over the next, whatever it's been, like better part of 20 years, we've had this, is it floating? Is it not? With periodic revaluations where it has been accused. And again, I'm trying to like put this in the most delicate political terms possible. Like, the Americans have regularly accused the Chinese of being currency manipulators, devaluing their currency to try to boost themselves as exporters. And this was kind of what kicked off. There was a big devaluation in 2015. It kind of kicked off all of Trump 1's policies of like, China as a currency manipulator, we need to put tariffs on them. In 2019, there was a big devaluation, and the tweets from Trump at the time, this was, I think, before Trump was blocked from Twitter, although I don't know. Like
it was. He wasn't blocked until 2020 after the U.S. election, where, yeah.
So over the course, as monetary policy shifted in the U.S. and we all of a sudden got into a regime of tightening before COVID and all that fun stuff, it was back and forth. And it's kind of been this like cold currency war. Then in 2020, 2021, China found itself in a real estate crisis. Real estate accounted for something like 30% of China's economy. And they had one of the biggest real estate developers. I actually don't know whether it's Evergrande, or just as much as I was on my high horse about pronunciation. But basically, I think it was the second largest property developer in China, pulled a Lehman Brothers and went under. And so Chinese real estate has been effectively in crisis ever since. So what's happened is, since we announced these tariffs, this young man's argument was, we are winning the tariff war because China's currency is depreciating. This is going to force their hand into some kind of stimulus internally. They're going to have to bail out what they've already been supporting and propping up through policy interventions and things like that. He may not be wrong on that front, but I want to be very clear that that's not happening in a vacuum where the US dollar is not also being devalued. So we are losing together. And the central tenet of so many people who say, oh, well, this is all part of some master plan, are all saying, but by the way, the Fed needs to bail us out and provide some kind of stimulus and provide easier monetary policy. So we've now got two economies where you may need to have some kind of stimulus, whose currencies are both crashing. And all it does is hurt, at the end of the day, investors in those economies and its citizens. So that was really just what I was responding to, is this is not the freely floating currency that you think it is. It doesn't have that history. And our goal, just like their goal, may be to have a weaker currency to some extent. So it's
which is just wild, though, because as one of the richest countries in the world, where we have a huge population that wants to buy lots of things, it's very surprising to me. And I feel like we're sort of becoming the like odd lots propaganda podcast. They had a really great guest on this morning who's like a PhD in like international trade. And he was talking about how consumers have not yet felt the pain of what is yet to come. He's like, come June, shit's going to get real. And it's interesting because, the markets, by the way, recovered yesterday because Scott Bessent was like, he sees de-escalation possible, right? And again, this guy was like, it takes multiple years to like work out trade deals. Like, this isn't something you snap your fingers. Now, I guess in theory, you'd be like, hey guys, by the way, like, we're just lifting all tariffs on China and we'll work out a deal. But like, because you have two people that both don't want to look weak, I mean, both sides need to come to the table. So like, I do think there needs to be a little bit more pain felt on either side. And the other thing is that, like, again, with China, they don't have elections. So like in the US, we do have elections. And if people get really unhappy, like, it as much as Trump says he doesn't look at the stock market, unhappy people, like, real prices do impact things, right? Inflation, I think a lot of people sort of pointed to one of the main things. I mean, there's a lot of reasons why, again, Biden potentially lost the last election, but inflation was obviously a very...
Biden wasn't running in the last election.
That's true. But this is fair. He was initially. But the main takeaway is your people being upset is something that in the US, leaders like can't ignore. In China, they can. So again, if you're going up against someone who like is not really held accountable, whereas you are accountable, I mean, it's a slightly different dynamic here. But
one of my favorite movie scenes of all time, possibly my favorite movie scene ever, is from a movie called Gattaca, which we went to go see. You and me were together for Kate Berman's 7th or 8th grade birthday. I can't remember. So shout out to Kate if she's listening. But there's this incredible scene where there's two brothers and they are having a swimming contest, basically. And they are swimming out into the ocean, and it's this dark, stormy ocean, and it's this battle of wills between the two of them to see who can swim out the furthest. And one of them is genetically engineered and one of them isn't. And the one who's not genetically engineered is outpacing the guy who should, by all accounts, be the superior swimmer, be the stronger athlete. And they get out and they get so far from shore that they're exhausted and near the point of drowning. And the guy who's genetically engineered turns to his brother and says, how are you doing this? How are you beating me? How are we this far out? We're both going to drown and die out here. And the other brother says, because I never saved anything for the swim back. He was willing to die out there to prove this point in this contest of wills. Yeah. And that's how I always think about it. If you're going up in a race against someone, you better know whether or not they saved anything for the swim back.
Yeah.
And who has the greater pain tolerance to wait something out. And so I think that that's, again, I'm no art of the deal. I am definitely not the best negotiator in the world. But if you're going up in a negotiation against someone, you better know what their pain point is and where they actually care and whether or not they saved anything for the swim back.
I love that, like that analogy.
So that's what I think about all the time. And I feel like potentially, again, we don't have a crystal ball. I don't have insight into all policymakers' decisions. But a way that we are now being like, just kidding, tariffs are off. Oh, they're back on. Oh, they're this, oh, they're that, or whatever. It's almost like we didn't gauge that up front. And we're hurting both of us.
Yeah.
Right? But who has the higher threshold for pain? I would argue that it's China.
I would as well. And it's funny because Jen and I, our goal here is not to be political. And I mean, clearly we have very strong opinions on what is going on here, but I want to make it very clear. Like, this isn't because of partisan reasons. And I actually it actually ended up being a constructive conversation with someone who was like commenting on a video of ours about the chairman of the Fed. Your comment last week, which was about Trump. Someone goes like, you made a terrorist threat. No, of course not. But the point was, I want to be very careful here because like, these conversations we're having, like, this is not meant to be political.
What I want to do is I want to give you guys just the facts of how markets work so that you can go make the decision about whether or not these policies make sense. We're saying, given what we know about how the fundamental truths of the universe work, does this make sense? Does this not make sense? What might happen? What might not happen? My goal is that you never know my personal politics, and all you ever know is, hey, Jen said that when rates go down, prices go up. Okay, so now I can make decisions about whether or not I think this monetary policy makes sense.
And I want to just explain why. Like, I mean, look, it's possible that through past episodes you can figure out my personal politics, but I mean, I don't trust people when I feel like they have a political agenda. I feel like they're basically just defending whatever the party line is and not being an independent thinker. And I think Jen and I mean, look, I think we're probably pretty centrist. Now, we do have strong feelings on certain issues, but like, it's not like they specifically line up with any political party. Like, different things will. And I, again, do feel very strongly about certain things, but like, again, it's, you know what I mean? Like, we try to be very logical with this stuff. And so I just wanted to make that clear because we have gotten a number of people that, again, on our posts
we get accused on both sides, but
that's like Moshe says that too.
Like the industry that we're in, like all different things, people will be like, oh, I assume you're this, and therefore I'm going to read whatever you're saying about markets through that lens. Not at all. Like that it's simply, and it's something we really pride ourselves on. So again, when I'm saying this, it's not because I'm pro or anti-Trump, right? It's just simply, to me, this is what the markets are telling us. Simply, the markets are telling us that, like, hey, every time you talk about more hawkishness when it comes to tariffs, markets go down, both the bond market and the stock market. That's not a good thing for US dollar denominated assets. So whatever you decide with policy, if you don't want it to be good for US dollar denominated assets, okay, like that's what right now the feedback from the markets, and hopefully we're giving you the framework within which to understand that.
Yeah. Well, and again, back to David Wu, who was this the guest on Odd Lots. He was talking about his guess is that in the administration, like, I don't know how they thought that these tariffs wouldn't be inflationary. So his posturing was that in the first administration, because they put tariffs on and it wasn't. But what China did is they did go to other countries, right? Other Southeast Asian countries, and they moved manufacturing there. So it didn't have as much of an impact. Now they can't do that.
Only had one term, right?
That too.
Like,
although Biden extended it, but
they extended it, but they didn't necessarily see it through. And so, like, who knows what the logical end of those initial policies might have been had Trump had a second term, had COVID not happened. Like, there's so many what ifs.
This is true.
So
this
it's
is
like,
true.
That's an alternate universe that we can't really opine on.
That's true.
But I have heard some arguments that, well, we were headed here eventually. We just had some exogenous factors that got us here in a roundabout route. Again, not an economist, so I'm simply not qualified to opine.
No, but again, just kind of thinking through the logics of running a business and how people literally manage and sell product. A big thing, and this is why he was saying, like, people have not felt the pain yet, because if you think about businesses, they build up inventory. That's like a huge thing. You want to sell a product, you need to literally, you get the raw materials, you have your works in progress, your finished goods, you then sell it. So companies have different like days of inventory. There's actually a calculation you can do, and that I teach when I teach like working capital projections, like inventory days. How many days of inventory it is?
By the way, you rock at teaching that. Like,
Thank you.
You do a timeline like no other.
I love timelines. Timelines are everything.
You love a timeline, girl.
I love a timeline. Actually, yesterday we were trying to look into certain things with regards to people applying for internships, and I was like, "Where's my damn timeline? Like, give me a timeline." But the point that I'm trying to make is that, look, companies have a certain amount of days that they basically have inventory that they can then sell off. And then they need to start basically getting more raw materials, putting together products, again, whether it's a finished good, whether it's a work in progress, whatever. And so companies are, again, still kind of in this process of depleting what they have. Like, it's only been 9 days, I think, since these tariffs went into effect. So as companies have to start now building their inventory back up and getting product from China, that is going to become a huge problem for them. Because right now, I also think people, like, just because there's so much uncertainty, they're like, I don't know what to do. Like, do I just wait for this trade? You know,
anything.
But that's the whole thing.
I don't know about you. Like,
that's
every time I get an email from like a clothing company being like 30% off, I'm like, unsubscribe. Like,
yeah.
Like, not even am I not clicking. I'm like, I am not making any purchases.
Well,
I'm not.
I hope that your interior designer doesn't listen to this, but you said yourself, you were like, I literally had reached out to my interior designer because I wanted to do some stuff. And you're like, I'm not doing that now.
Well, like, it's funny because like she hasn't gotten me the proposal back. And I'm like,
probably because she doesn't know what the cost is. But yeah.
Take your time.
So anyway, that was why his whole point is that, look, consumers have not started to feel the pain. The pain is coming. It just is going to take time for people to start seeing the prices go up and getting unhappy. I obviously already got that email from Up a Baby. We talked about Munchkin, right? The little like baby sippy brands who they've said they're running out of inventory.
Cups, by the way, if you guys don't have kids and you don't know, there are these sippy cups designed by like, I don't know, either Albert Einstein
Munchkin.
or like the devil himself. Because when you first see them as a parent, you're like, how does the water come out? It's very confusing because it's just this lid and there's what looks like a button in the middle and you're like, do I press this button?
No, the best one is the weighted straw.
Suck on the like side of where the lid meets the cup. I mean, truly, we had no idea.
It's this technology, right, that is basically designed so that your kid can drink water while not spilling it everywhere. So they have like different types. They do still spill. But there's like this like weighted straw one. So basically there's like a straw, and then like you can like turn it upside down and you can still drink out of it. It's again, like it's only Munchkin that makes this shit, or that I've seen. So anyway, but speaking of the whole fiasco with the tariffs, I think were just not that well thought out. And I feel like that is what obviously the market is reacting to. The other thing, because again, we did want to talk about Yale, but what's also interesting is, did you see that apparently the letter that was sent to Harvard was never supposed to have been sent?
Well,
that was
so like, but was it like,
no, apparently like it was
was it really not supposed to have been sent, or was this just walking something back?
Oh, it's possible it was walking something back, but like if you look at some of the demands versus the demands with Colombia, these demands were much more extreme and again, overstepping and like all that kind of stuff. And so again, to your point, very possible it was sent and then it shouldn't have been, but supposedly it was like in draft form and they wanted, and it was, anyway, so it was sent. Harvard obviously made it public.
That literally feels like, you know, if you're cheating on your partner and you send something like, hey babe, last night was great, and then it's like you send it to the other person and you're like, oops, wrong text, didn't mean to send it, or whatever, you know, like.
Yeah, so anyway.
Not that I have experience with cheating on my partner, and this is something I'm an expert in, but like that's what it felt like oops, didn't mean to hit send on that email. Like,
but no, so the whole thing is that there's this war that is now starting between, again, the administration and the university. So we talked a little bit last week about why we think cutting funding is not the way to go about it, but that is neither here nor there. Obviously, endowments are one of these major institutional investors that we talk about all the time when we talk about like who you're raising money from. If you are a private equity firm, a hedge fund, whatever it is, like you are going to the Yales, you are going to the Harvards, you are going to the people who have all this money and need to basically allocate it. And so as there is a lot of uncertainty now with regards to what the rules are going to be with regards to endowments, the tax exempt status, the funding, all this kind of stuff, endowments are starting to think about what should we do. And by the way, this is not even taking into account what is happening in the markets. And because, by the way, apparently, so there was a Bloomberg article that came out that said Yale has actually been looking into doing this, which we're about to talk about, doing a sale of their private equity portfolio for months now, which again, maybe there was, like, they did see that the writing on the wall, that there was going to be some back and forth with the administrations. That's obviously possible. But we've talked in the past about like the Swenson model, where again, it's actually really cool because literally the person who invented it was the chief investment officer, right? The CIO of Yale. And now obviously Yale is rumored to be selling out. So they have a $41 billion endowment. They're rumored to be selling $6 billion of their private equity portfolio, which is specifically related to leverage buyouts. And so we talked about the denominator effect and sort of what's going on in private equity. But I want to take a step back and just remind ourselves that like private equity in general is a risky investment. We talk about like the risk reward spectrum. The higher the risk, the higher the reward. These are illiquid investments where you are buying the equity in companies that are private and piling a shit ton of debt on it. So if you just think about it, again, that particular type of investment, if the tariffs are to go through, like we just mentioned what's happening with inventory and all that kind of fun stuff. I mean, that does not look good from almost like a profitability standpoint. Even if like you can withstand volatility in the markets, like it has nothing to do with the markets. It has to do with the fundamentals of you now have lower profitability, potentially, again, TBD on the tariff side, but like we know that there are some tariffs that are probably staying. So you're going to have issues there. And then on the borrowing side, so again, these private equity firms, they pile a ton of debt on the business. And because of now the increased risk associated with the, again, profitability of the business and all that, now all of a sudden it is going to typically be riskier to borrow money. So there's a whole bunch of almost like issues with regards to that asset class, not to mention that these investments were made oftentimes like multiple years ago. And like the private equity firms need to basically return cash to investors. And because the M&A markets are closed, the IPO markets are obviously like closed for the most part. That is a problem because now these endowments or whoever potentially needs cash is not going to be able to get out. So what do? They go to something called the secondary market. And so it was announced, again, this was in like Secondary Investor, that Yale had engaged Evercore to help them with a sale of their private equity portfolio via what's called a secondary. And so, by the way, we actually had an MD from Evercore, Justin Resnick, on way back. I want to say it was probably a year ago at this point, to explain secondaries, because there's different ways that sort of you can there's different types of secondaries. There can be one where it's, again, like the investor is trying to sell out a stake. It could also be one where, again, the GP, right? So your Carlyle or Apollo wants to basically take crown jewel assets and like spin it off into something called the continuation fund. So we'll link that in the show notes if any of you guys are interested in learning more about secondaries. But it is, like I said, very interesting that they're in the market trying to basically sell out of $6 billion of this portfolio. And so a couple of other things to keep in mind, which this was reported by the Secondary Investor, I think it's called, but they had said that Yale claims that they're still potentially looking to do new investments in private equity. Now, I don't know if it's still specifically leverage buyout strategy. Like you think about private equity, I mean, private equity, most people, we use the term PE and it refers to, again, that leverage buyout strategy, but like technically, it also theoretically can kind of refer to venture capital or to growth equity. So like there's different places along the timeline where you can invest in a business. Again, typically the leverage buyout is the most, when we say private equity, what people tend to think about. But again, like there are different almost like strategies. Again, venture capital, I don't think is like doing that amazing right now either. We had talked to our friend Camilla who said denominator effect is affecting them too. So it's not just private equity. But the other thing that's interesting is that according to, again, a different Bloomberg article, there's a number of PE firms that basically won't approve LP. So again, the like your Yale Endowments, they're a limited partner, the LP transfer, so the secondaries, unless the sellers, like unless in theory Yale commits to basically make some fresh commitments to their new funds. So like you can sell out of this existing fund, but you need to basically like essentially pay up to invest in our new fund. Now, for someone like a Yale, I don't think that they're necessarily able to like bully them around. But for smaller investors who potentially want to cash out and who want to get liquidity, that is something that is happening in the private equity space. So just thought that was really interesting. And it's like everything just like kind of keeps coming together. This is why it's fun to explain all this stuff in the context of what's going on in the markets. And if you were in our class yesterday and we talked about how are tariffs potentially impacting private equity portfolio allocation, this is the answer to that question.
Yay!
So awesome. I feel like we'll try to link a number of the things that we talked about in this episode, because we did talk about, again, private equity secondaries. We talked about the Caesar Palace coup. Again, that was like one of my favorite series that we did. So definitely check that out if you haven't. So for those of you guys who come here to not listen to us, we apologize that it's been us more than normal. We are going to be getting back to our regularly scheduled interview episodes. So as we said, we have a number that are in the pipeline. We have like an emerging credit episode. We have, again, some like really amazing ones. And then we're doing an interview tomorrow with a really cool guest. And so we're really excited for that episode to air. But in the meantime, if you haven't already done so, please leave us a written 5-star review. Send this to a friend if you think that they would benefit. And as always, we will see you next time.
Bye.
Bye, guys.